Welcome to the deep dive. Today, we're going to be taking a journey through the financial philosophy of one of the most celebrated investors of all time, Warren Buffett.
Right.
Now, you're interested in getting a deeper understanding of how he
Yes.
approaches investing, so we'll be using excerpts from
Okay.
Roger Lowenstein's biography to trace the evolution of Buffett's thinking, starting from his early days all the way to becoming the Oracle of Omaha.
What's striking about Buffett's story is that it's not just about stocks and bonds.
Right.
It's about how specific traits and experiences, even from childhood,
Oh, yeah.
helped him develop the principles that guide his investment decisions.
Let's start with those early years.
Okay.
Lowenstein describes how Buffett was already exhibiting an entrepreneurial spirit as a young child during the Great Depression.
His childhood experiences during that time had a profound impact on him.
Yeah.
He wasn't just learning about financial hardship theoretically.
Right.
He was living it. That instilled in him a deep desire for financial security. But it went beyond just wanting wealth.
Okay.
It was about having the ability to control his own destiny.
And that ambition was evident very early on.
Yes.
Lowenstein talks about him setting up a chewing gum stand at age 5.
Wow.
It's remarkable to think about a child that young having that kind of initiative.
Exactly.
Yeah.
And that entrepreneurial spirit was further demonstrated in high school
Okay.
when he and his friend Don Danley started a pinball machine business.
Oh, wow.
They placed machines in barbershops, charging people to play.
Oh, okay.
What's fascinating is that they weren't just winging it.
Right.
They had a plan.
Okay.
They strategically targeted rural areas to avoid competition from organized crime.
Oh, interesting.
And they even came up with a clever tactic when negotiating with barbershop owners.
What did they do?
They pretended to be young assistants working for a powerful, unseen boss.
Really?
This allowed them to secure better deals and expand their business rapidly. Within a month, they had 7 locations up and running.
Wow. That's incredible for a couple of high schoolers.
Yeah.
It speaks volumes about their business savvy and ability to think strategically, traits that would serve Buffett well later in his career.
Absolutely.
Yeah.
But alongside this entrepreneurial spirit, Buffett was also developing a deep understanding of the financial world, thanks in part to his father, who worked as a stockbroker.
That must have been quite an education growing up, surrounded by ticker tapes and financial discussions.
Right.
Lowenstein mentions that Buffett was already analyzing those tapes as a child.
His father's work demystified the world of finance for him.
Yeah.
Imagine the impact of being taken to Wall Street at age 10.
Yeah.
While most kids that age might have been bored, Buffett was captivated.
Right.
He was already demonstrating a fascination with stocks and the way the market worked.
It's clear that these early experiences shaped his thinking and laid the groundwork for his future success.
Yeah.
And speaking of success, he bought his first stock at 11 years old. 3 shares of City Service, preferred making a small profit.
Even though it was just a small profit.
Yeah.
That first stock purchase provided a taste of what was to come.
Okay.
By the time he graduated high school in 1947, his yearbook entry read, "Likes math."
Wow.
A future stockbroker.
It seems his path was pretty much set.
Yeah.
And then he went on to the Wharton School of Business, right?
He did.
Okay.
But what's interesting is that even though he already had considerable knowledge about investing,
Yeah.
he found the coursework at Wharton unfulfilling.
Really?
He craved practical knowledge and real-world application,
Yeah.
something he felt was lacking in the theoretical curriculum.
So what did he do?
Instead of passively attending classes he didn't enjoy,
Right.
he spent his time doing what he loved, analyzing stock trends and connecting with other investors.
Okay.
Yet, even with his disinterest in the academic aspects,
Yeah.
he still managed to excel in his exams.
Wow.
His memory for financial data was remarkable.
It seems like he was driven by a deeper purpose than just getting good grades.
Precisely.
Yeah.
It's clear he was already on a quest for mastery in the field of investing, seeking knowledge and experience that went beyond traditional academic settings.
And this quest for mastery led him to Columbia University to study under Benjamin Graham,
Yes.
the father of value investing.
Right.
Graham's philosophy resonated deeply with Buffett, providing him with a structured framework for approaching the market.
Graham's influence on Buffett cannot be overstated.
Yeah.
He introduced him to the concept of viewing the stock market not as a chaotic frenzy,
Okay.
but as a system where true value eventually emerges.
That seems like a crucial distinction.
Yes.
How did Graham define value in the context of investing?
Well, Graham believed that the price of a stock doesn't always reflect its intrinsic worth.
Yeah.
He taught that by carefully analyzing a company's financials, its assets, earnings, and potential for growth, an investor could identify undervalued opportunities,
Yeah.
stocks that were trading for less than they were truly worth.
It sounds like this approach requires a lot of patience and discipline.
Oh, absolutely.
It's about looking beyond the hype and short-term market fluctuations to uncover hidden gems.
Exactly.
Yeah.
It's not about chasing trends or making quick profits.
Right.
It's about taking a long-term perspective,
Okay.
identifying companies with solid fundamentals, and holding on to those investments even when the market might be telling you otherwise.
This resonates with what we've seen in Buffett's early experiences.
Right.
The meticulousness of the newspaper delivery,
Right.
the strategic thinking behind the pinball machine business,
Mm-hmm.
and his fascination with understanding the financial markets from a young age.
Yeah,
All these experiences seem to have prepared him for Graham's approach.
absolutely.
Yeah.
And those foundational principles learned from Graham were further refined and expanded
Okay.
through his partnership with Charlie Munger, whom he met when he was 29.
It sounds like Munger played a significant role in shaping Buffett's investment philosophy.
Definitely.
What did he bring to the table that Buffett was missing?
Munger had a unique perspective that challenged some of Buffett's earlier practices.
Okay.
In the beginning, Buffett was very focused on what he called cigarette butt investing.
Cigarette butt investing. What does that mean?
It refers to buying deeply undervalued, struggling companies.
Oh, okay.
Much like picking up discarded cigarette butts for a final puff,
Right.
he'd extract whatever value he could and then move on to the next one.
Okay.
While this approach could yield quick profits,
Mm-hmm.
it often involved investing in companies with fundamental flaws.
It sounds a bit risky betting on companies that are already struggling.
Exactly.
Yeah.
And this is where Munger's influence becomes crucial.
Okay.
He argued that instead of focusing on cheap, potentially flawed companies,
Right.
it made more sense to invest in high-quality assets for the long term.
So a shift from bargain hunting to betting on excellence. That's quite a significant change in thinking.
It was a pivotal shift that led to a more refined and ultimately more successful investment approach.
Mm-hmm.
Munger convinced Buffett to focus on companies with durable competitive advantages,
Right.
those with what they called moats.
A moat, like a castle moat.
Yes, like a protective barrier that surrounds a castle.
Okay.
It's a metaphor.
Right.
In business, a moat refers to any factor that gives a company a sustainable advantage over its competitors.
Okay, that makes more sense.
Yeah.
So what kind of factors create these moats in the business world?
There are several types of moats.
Okay.
For example, a company might have a strong brand that commands customer loyalty,
Right.
like Coca-Cola.
Yeah.
That brand recognition acts as a moat because it makes it difficult for competitors to steal market share.
So even though there are countless beverage companies out there,
Right.
Coca-Cola's brand recognition sets it apart and protects its market position.
Exactly.
Okay.
Another type of moat is a cost advantage.
Okay.
Think of a company like Walmart,
Mm-hmm.
which has mastered the art of keeping its costs low,
Right.
allowing it to offer lower prices to consumers.
That makes sense.
Yeah.
It's hard for competitors to compete when a company can consistently offer lower prices.
Right.
Yeah.
Other moats might include proprietary technology, unique patents,
Okay.
or a network effect, where the value of a product or service increases as more people use it.
So Buffett and Munger were looking for companies that weren't just profitable,
Right.
but also had these built-in advantages that would allow them to maintain their profitability over the long term.
Precisely.
Yeah.
They recognized that investing in companies with strong moats
Okay.
provided a greater margin of safety and a higher probability of generating consistent returns over time.
This shift towards quality investing is fascinating.
Yeah.
But how did this new approach manifest itself in their actual investment decisions?
The story of Berkshire Hathaway perfectly illustrates this transition.
Okay.
You see, it began as a struggling textile company, a
Right.
classic cigarette butt investment that Buffett initially bought into.
So the same Berkshire Hathaway that's now this massive conglomerate with investments in everything from insurance to candy
Right.
started as a textile mill.
Yes.
That's quite a transformation.
It is.
Wow.
And it speaks to their vision and adaptability.
Mm,
They didn't try to revive a dying industry.
right.
Instead, they recognized that Berkshire Hathaway could be used as the vehicle for something much bigger.
Okay.
It became their investment platform,
Right.
allowing them to acquire and nurture a diverse portfolio of companies that met their new criteria for quality.
So what kind of companies did they start acquiring under this new philosophy?
Think iconic brands like Coca-Cola, American Express, Geico Insurance,
Wow.
and even Dairy Queen.
It's quite a range.
Their portfolio became incredibly diverse, reflecting their long-term investment philosophy
Right.
and their bluff in back and strong management teams.
Right.
They weren't just buying stocks, they were acquiring pieces of businesses they believed in.
It sounds like they were creating a financial ecosystem, a collection of companies that not only generated profits, but also represented enduring value.
That's a great way to put it.
Yeah.
By focusing on companies with strong moats, competent management,
Right.
and businesses, they understood
Mm.
they built a portfolio that has consistently outperformed the market over decades.
This is a fascinating insight into how Buffett and Munger's thinking evolved.
Yeah.
But there's still one piece of the puzzle I'm curious about.
Okay.
We've talked about the concept of quality investing, but
Uh,
how did Buffett actually go about identifying those high-quality assets?
Right.
What specific criteria did he use to make those investment decisions?
That's the real art of value invested, isn't it?
Yeah.
And while there's no magic formula,
Right.
Buffett looks for a few key characteristics.
Okay.
First and foremost, he wants to understand the business.
Okay.
He often says that he doesn't invest in companies he can't explain to a 10-year-old.
Right.
This means he favors businesses with relatively simple and transparent operations, ones that he can grasp easily.
That makes sense.
Yeah.
If you're going to be a long-term owner of a business, it's essential to understand how it works.
Precisely.
Right.
He's not looking for the next hot tech startup with a complex business model that's difficult to decipher.
Right.
He wants companies that generate consistent cash flow,
Mm-hmm.
have manageable debt levels,
Okay.
and operate in industries he understands.
It sounds like he's emphasizing prudence and avoiding unnecessary complexity.
Exactly.
Yeah.
And along with understanding the business,
Right.
he's also keenly focused on the quality of management.
Okay.
He wants to see a team that's competent, ethical,
Mm-hmm.
and aligned with shareholder interests.
Right.
He often says that he'd rather invest in a good company with a mediocre management team
Really?
than a mediocre company with a good management team,
Okay.
because he believes that good management can elevate a good business to greatness.
So it's not just about the numbers on the balance sheet. It's about
Yeah.
the people running the show.
Absolutely. He looks for managers who are honest, capable,
Mm-hmm.
and have a long-term vision for the business.
Mm-hmm.
And finally, beyond the financials and the management,
Yeah.
he assesses what he calls the intrinsic value of a company.
Intrinsic value. What exactly does that mean?
It's essentially a measure of a company's true worth,
Okay.
independent of its current stock price.
Right.
It's based on a careful analysis of its assets, earnings,
Mm-hmm.
growth potential, and any other factors that contribute to its overall value.
Okay.
Buffett believes that in the short term, the market can be irrational,
Right.
driven by fear and greed.
Yeah.
However, in the long term, the market will eventually recognize a company's true worth,
Mm-hmm.
and its stock price will reflect that intrinsic value.
So he's looking for companies that are undervalued by the market,
Yes,
where the stock price is lower than what he believes the company's truly worth.
that's right.
Okay.
It's the core principle of value
Yeah.
investment. Buy low, sell high.
Right.
But instead of trying to time the market,
Right.
he focuses on identifying companies with strong fundamentals, solid management,
Right.
and a clear path to long-term growth.
Mm-hmm.
He's willing to wait patiently for the market to catch up to his assessment of a company's intrinsic value.
This long-term perspective seems to be a recurring theme in his approach.
Yeah.
It's not about quick flips or chasing the latest fads.
Right.
It's about investing in companies that he believes will continue to create value for years,
Yeah.
even decades to come.
Exactly. And that brings us back to the concept of those moats we discussed earlier.
Yeah.
Buffett sees them as essential for ensuring a company's long-term success.
Can you give us some examples of how those moats play out in the real world using companies in Berkshire Hathaway's portfolio?
Of course.
Okay.
Think about a company like Coca-Cola.
Okay.
It has a brand recognition moat.
Right.
Its logo is instantly recognizable around the world,
Mm-hmm.
and it has a loyal customer base built over decades.
Yeah.
That brand strength makes it incredibly difficult for competitors to make a dent in their market share.
Right.
Or consider a company like Geico,
Right.
which leverages technology and a direct-to-consumer model to offer competitive insurance rates.
Okay.
This operational efficiency acts as a moat
Right.
because it allows them to undercut competitors on price while still maintaining profitability.
It's fascinating to see how those moats translate into real-world advantages for these
And
companies.
those advantages translate into long-term value for investors like Buffett.
So as we wrap up our deep dive into the world of Warren Buffett,
Right.
what key takeaways would you leave our listener with?
I think the biggest takeaway is that successful investing is not about speculation or gambling.
Okay.
It's about understanding businesses,
Hmm.
identifying those with enduring competitive advantages,
Yeah.
and being patient.
Yeah.
Buffett's story highlights the importance of thinking long-term,
Okay.
focusing on fundamentals,
Mhm.
and seeking out companies that are managed well and positioned for sustainable growth.
It's a valuable lesson for any investor, regardless of their experience level.
Absolutely.
Yeah.
And remember, just as Buffett learned from his mentors and partners,
Okay.
continuous learning and adaptation are key.
Right.
The market is constantly evolving,
Yeah.
and successful investors need to evolve with it,
Thank you for sharing these valuable insights with us.
of course.
And to you, our listener, we hope this exploration of Warren Buffett's journey has provided you with a deeper understanding of his approach to investing.
Mm-hmm.
Perhaps it has even sparked some ideas for your own investment journey.
Yeah.
Until next time, keep learning, keep exploring, and keep diving deep